Right, guys, we're going into another section, namely a debtor's age analysis. Now, when we talk about a debtor's age analysis, we're certainly not talking about the age of the debtor. We are talking about the age of the debt, and that is important. Okay, once again, a debtor's age analysis is part and parcel of internal control to ensure that we minimize our bad debts, to ensure that our debtors pay us timeously, and obviously to ensure that we have cash, that we don't experience any cash flow problems, to ensure that the company is liquid at all times. So what does a debtor's age analysis actually do? It talks about the terms, right? That means, what are we allowing our debtors? Are they complying with the terms? And also it looks at, in terms of the debtors, in terms of the amounts that they are owing, are they complying with the limits? Okay, so one, the credit terms. If you are allowing your debtors 30 days in which to settle your accounts, are they paying their accounts within the period, namely 30 days? Remember what I said, if they don't pay you within 30 days, you may experience liquidity or cash flow problems because the money is not coming from your debtors and you need that money to settle your debts and to pay your creditors on time, right? And then, are they complying with their credit limits? If you've given them, for example, if you've given a debtor a credit limit of 5,000 Rand and you find in his or her account the amount is standing at 8,000 Rand, clearly the debtor is not complying with the credit limits. Also, it means from our side, we're not ensuring that all debtors comply with their credit limits. Okay. So now, if we look at this here, we can see that all accounts are to be paid in 30 days, right? And they are entitled to a 2% discount. Once again, what do? We provide incentives to our debtors that if you do not pay if you do pay within the prescribed time, within 30 days, you will be entitled to a 2% discount. So this is called, you're providing an incentive. It's called the carrot method. You know, when you dangle a carrot in front of a mule to make it move, that means you're providing an incentive. And in this way, your debtors obviously are going to pay their accounts because they're going to get a discount. And if the account is not paid within 60 days, then you're going to charge interest. And this is where we're imposing a penalty, and it's called the stick method, where if the donkey doesn't want to move, then you use a stick to get it to move. Obviously, we're not going to be cruel to animals. That's just an expression that we use. So in other words, what we're saying is, if they settle their accounts on time, we provide an incentive. If they do not settle their accounts on time, we penalize and we charge interest on the overdue accounts. And if the account is not paid within 90 days, the account is handed over, right? We're going to talk about that just now. So here's an example of a debtor's age analysis. Let's look at the questions that we have to answer. 1, how does the preparation of a debtor's age analysis assist in the control of debtors? It's all about the control of debtors, right? Let's look at it here. We can see 1, it shows you which debtors do not keep to their credit terms. Remember we spoke about that, right? Then, if they are not complying with their credit terms, we need to take action. We need to take action to encourage them to pay, because we want our debtors to settle their accounts timeously. And obviously, very important, we want our bad debts to be kept to a minimum, because we don't want to write off bad debts. Just on the story of bad debts, guys, in school accounting, you get a transaction that says bad debts to the amount must be written off. It doesn't just happen that way. In practice, you actually follow a procedure where you take the necessary action, and the last step that you take is if it is now costing you more to try and retrieve the debt from the debtor, then what you do is you have no choice but to write off the account as a bad debt, as irrecoverable. But it's not something that is a decision that is just taken on the spur of the moment. It's actually a management decision that once you've tried all possible means to try and recover your debt, and if you can't do it, then the last one obviously is to write off the bad debt, or to write off the debt as a bad debt, as an irrecoverable debt. Okay. The question said here, how much is owed by our debtors on the 31st of May? Let's see how much do they owe us. So here we go. We have an amount of 4,250 plus the 970 plus the 3,500 plus the 3,075 plus the 9,635. So clearly you can see, using my debtors age analysis, my answer is, there we go. All those amounts added together will give me my total debt outstanding, which is 21,430, right? In other words, you take each component of the debtors age analysis. Remember, that's the current amount, that's outstanding for 30 days, that's outstanding for 60 days, that's outstanding for 90 days, and this is outstanding for more than 90 days. Right, the next question said, which debtor would you gladly give a credit reference to? Now, obviously, very often you have companies asking for a credit reference. That means if you want to go and buy goods on credit, or you want to buy something on credit, you must go with a credit reference. Obviously, that credit reference will be given to you by the person that you're already dealing with. So in our case here, let's look at our debtors and see, okay, if you look at H. Haste, only has a current amount outstanding, right? So definitely H. Haste will be given an A+ credit reference. And also if you be fair, you have these two here, G. Good, and okay, that's the only one I can see. Yes, that's right, G. Good, who also may qualify for a reference because you are allowing them to pay your account within 30 days. So G. Good is actually complying with the credit terms. So yes, if you were to give a credit reference, you would actually give a credit reference to H. Haste and Good as well, because both of them are compliant with their credit terms. Okay, next question. Which debtor would be handed over, and what does this mean? Okay, let's go and see. Clearly you can see that C. Conman has an account that's outstanding for more than 90 days, right? And what were our terms that we agreed on with the debtor? If any account is not paid within 90 days, the account is handed over. Remember I told you, we'll come back to that one. So here we go. C. Conman. This means the account will be handed over to an attorney, right, who will contact the debtor and give him or her a certain time to pay the account. Failing which, if the debtor does not pay the account, he can be sued, and obviously you can institute legal action can be taken to force the person to settle their account. So this is what we mean by saying a debtor will be handed over. So if we have to summarize our debtors age analysis, one, we deal with the credit terms, right? That means what are they complying with the credit terms that you have given them? And also we talk about the credit limits. That means, are they complying? This particular debtors age analysis of ours did not have information, but you could have an information here telling you that the credit limits of the particular debtors could have been specified here, and then obviously you could use that to determine who's complying with their limits and who's not complying with their limits. Okay, debtors age analysis. The question now says, why is the preparation of a debtors collection schedule and a debtors age analysis an important part of the internal, of an important or an integral part of the internal control measures that a business needs to put into place. One, your debtors collection schedule projects anticipated receipts from your debtors. Two, it ensures debtors keep to their credit terms, and we can act immediately if the debtors do not comply. So if we look at our debtors collection schedule, from there we can identify immediately, are they, firstly, the projected amounts we expect to receive from our debtors, are they abiding by their credit terms, and if they are not abiding by their credit terms, what action can be taken against them. A debtor's age analysis, on the other hand, is an effective method of controlling the length of overdue periods so that appropriate action can be taken, such as interest or legal action. Right? So once again, your debtor's age analysis assists you in controlling the length of overdue accounts. That means the age of the debt. Right? Like I alluded to early on, the age of the debt. And also, you can identify a possible bad debt. And what do we use our debtors age analysis for? To send reminders to our debtors for them to pay timeously. So reminders can be sent to them to ensure that they cannot complain, or they cannot come back and say, listen, I didn't know the debt was outstanding, you didn't send me a reminder. Your debtors age analysis can be used to good effect to send reminders. You can send them in the form of SMSs, messages, whatever, informing your debtors that their accounts are overdue or they're not complying with their original agreements.